Okay, what is up, tycoons? What's up, traders? Super excited for today's video. Yet another natural gas video. In today's video, we're going to be covering the natural gas spot price, okay, the actual price of natural gas itself. We're going to take a look at UNG as well as Boyle and do some really nice technical analysis on those. But before we jump straight into the TA, what we're going to do is actually go over a quick slide presentation covering some of the recent news and covering a lot of the data hidden behind, the actual movements in natural gas rather than just technical analysis. So if you want just a TA, all you have to do is fast forward to the second half of the video. And this first half of the video is going to be some really useful information, as well as at the end of it, I have some of my own charts that I made on here that are also very, very interesting as well. Really good info. Okay, so make sure to smash the like button, subscribe to the channel if you guys are new, and we're going to jump straight into the presentation now. Okay, so we're going to start off here. And we have an article here. Now, I highlighted Jim Cramer right here. I underlined this. A lot of people are familiar with the Jim Cramer effect, okay? And it's something that's kind of funny with Jim Cramer, but essentially what they do is they say that, whatever he pumps, dumps, and whatever he says to dump ends up pumping. But we see that the collapse in natural gas may be overdone. So we're adding to one of our energy stocks. Now, Jeff Marks is also one of the people on this article, so maybe there is a little bit of sense to it. Now, I actually have my UNG position. This is as of yesterday, so I haven't even checked it today. I am recording this during market hours, so maybe I'm up, maybe I'm down. Not too sure specifically, but I just wanted to be fully transparent. Now, I started this position, and this is shares. This isn't options or anything. This is in my Roth account, okay? So, time necessarily isn't a factor. It's a very, very small starter position. And if things, continue to go down, I'm comfortable adding to this position and increasing my position size. Now, it's not financial advice. Again, not telling you guys to buy it, but I'm just, showing you guys that I do have, some skin in the game in this right now. Okay. Recently, I started a position. So here's our first article, or our next article we're going to look at. Look at the headline here. Eugene, all right, is the first city in Oregon to ban natural gas appliances in new homes. Now, we all know that the West Coast and, Oregon, California, Washington, a lot of those places, they tend to be a little bit more snowflake and, very against natural gas. But this is a trend that, most likely will continue in the future, but just at a slow pace, right? I'm not saying by, in the next 5 years, natural gas appliances are going to be banned everywhere. But, 20, 30 years from now, that may be something that's a lot more common. All right. The next one we have here. So analysts tear up their predictions for higher natural gas prices. This is Antero Resources, Williams, Coterra Energy, and then the natural gas futures. And this is just kind of a chart showing the futures and share price performance. This is a weekly chart right here. And you see, it's not looking too good for natural gas, right? So an unusually warm winter has analysts rolling back their forecast for natural gas prices and shares of producers. Natural gas futures have fallen more than 1/3 this year, extending a streak of wild trading in the heating and power generation fuel. Prices now stand lower than they did at this time last year before Russia's invasion of Ukraine jarred energy markets. I mean, that's pretty crazy, guys, that the prices are now lower before Russia's invasion of Ukraine. Now, the EIA, the Energy Information Administration, all right, they think that that a tight LNG market will continue as they see the lowest natural gas price, or the lowest natural gas export capacity additions in decade. So they estimate this year will bring the lowest amount of LNG export capacity additions in a decade, exacerbating expectations for a tight global natural gas market through 2025. We have a nice chart here, kind of just depicting that, and nice colorful chart here, just showing you. Okay, but look at this next one. It says, what gains? Natural gas future traders slam brakes on rally as cash stabilizes. And at a glance, you see that production fully recovered. There's a storage surplus seen swelling, and cash prices are mostly steady. Nat Gas Weather said milder weather would quickly return by next week, with pleasant highs in the 50s to 80s, leading to very light demand at the national level. There is some chillier weather in the forecast for the February 17th to 19th period, but at least some of the data is showing a quick return to warmth by February 20th. If the devil is in the details, it's the trend of a quick warm-up following any cold blast that has resulted in plentiful storage stocks and some of the lowest natural gas prices seen in years. What's more, after Thursday's round of government inventory data, stocks could improve further amid the mostly warm February outlook. And so that's what this chart right here is basically showing you guys, right? I kind of just read, what is on this chart here. And you can see their range of expectations. You can see the previous 4 weeks, weekly change, year-over-year difference, things like that. Now, that being said, EBW said the natural gas outlook may find more enduring support this spring, which goes against the traditional slide that accompanies the shoulder season. As long as spring weather is not unusually mild, rising feed gas deliveries to Freeport LNG and coal to gas switching could provide a boost to prices. At the same time, production could continue to run into constraints, limiting any incremental rise in supply. Furthermore, EBW said the market, with sub-3 prices seen through June, appears to be pricing in ultra-bearish scenarios that are unlikely to materialize. And I do say that I kind of agree with this, right? I mean, they're really pricing in these ultra bearish scenarios, and that's why you're seeing, this ultra bearish outlook in performance when it comes to natural gas and UNG and oil and things like that. On the supply side, pipeline constraints continue to pose a risk, particularly in the Permian Basin, and there's also the possibility that producers may be slow to respond to current price signals. Now, buying the dip has cost natural gas bulls a fortune. A 14-year high bullish sentiment gripped the market when the nearby natural gas futures rose above the $10 per barrel level in August 2022. However, the bullish trend ran out of upside steam, causing many market participants to buy the dip because of sky-high European prices going into the winter season. The dip turned into price carnage as natural gas dropped to the lowest level since December 2020, and nearly 1/4 of the level at the August high. Now, this chart highlights that the plunge took nearby March natural gas futures to the lowest. It's on February 3rd. Buying on the dip was a losing proposition as the energy commodity continued to make lower lows as the price sunk into a bearish abyss. And, a lot of people got stuck buying in at these levels, and it's really just collapsed, right? Really, really fell very, very harshly. And now natural gas. No inventory and supply concerns caused the price plunge. U.S. natural gas futures did not post the same all-time peaks as the energy commodity in the UK or the Netherlands in 2022, which is, pretty interesting, right? Over here, we have the weekly natural gas storage report. Okay. Now, stockpiles have become a fundamental bearish factor for the U.S. natural gas market. And, basically that's what this whole chart is highlighting right here. Okay. U.S. inventories have turned bearish over the past months. Natural gas and storage across the United States was below last year's level and the 5-year average. Over the recent weeks, that trend changed. And so the chart shows that 2.583 trillion cubic feet natural gas inventories were 9.4% above last year's level and 6.7% over the 5-year average at the end of January. In March 2022, U.S. natural gas stockpiles fell top 1.382 trillion cubic feet at the end of the peak withdrawal season. At over 2.5 TCF on January 27th, stocks are unlikely to fall near that level when natural gas begins flowing back into storage during the injection season from late March through November 2023. And over here, this is something just pretty useful. All right. A little bit of, some caution for people. So be careful with the ETF and ETN products. A decline into negative territory could cause havoc. Right now, the 3 most liquid products providing market participants with exposure to the natural gas market are UNG, there's oil, as well as coal. So UNG tracks nearby natural gas future prices and rolls to the next active month contract 2 weeks before expiration. Rolling natural gas futures from 1 month to the next is a significant risk that causes distortions in the UNG product. Oil is a bullish product that seeks to deliver twice the percentage performance of nearby natural gas prices on the upside. The leverage causes oil to suffer from time decay with reverse splits. Oil is only appropriate for short-term risk positions. Coal is a bearish product that seeks to deliver twice the percentage performance of nearby natural gas prices on the downside. The leverage causes coal to suffer from time decay with reverse splits. Coal is only appropriate for short-term risk positions. And that's something that I kind of wanted to highlight is, you know, in my opinion, a lot of these leveraged ETFs and things like that, they're mostly for you know, quick trades, guys, for day trading. Okay, like let's say you're not into options and you want to get some type of leverage, and you know, making a day trade, so that way you don't just capture a 1% gain. Maybe you can get a 2, 3, 4, 5% gain off of a day trade using something like bull and cold. All right, now that's just my opinion. Okay, you can buy and hold some of these, but you know, you do suffer from a lot of things. You know, there's time decay, volatility decay, things like that. So now that we've pretty much finished the presentation, all right, I have some charts here that I've made up myself. Now, this is the price of natural gas divided by XLE. Okay, so when you're seeing this go up, natural gas is outperforming. And when you see this go down, energy, XLE, the energy sector of the S&P 500 is outperforming. Now, these are the all-time lows right here, guys. Okay, this is the all-time low. We recently just broke the low before that, all right, and we cracked that low. We are starting to pop up a little bit, but look in relation to this, guys. I mean, these are really, really historic lows, and we're potentially even heading to retest some of the all-time lows of this chart, right? And so the whole concept behind investing is to buy low and sell high. Now, remember, I'm not giving you guys financial advice, but I'm just showing you the pure data, guys. And this is pure data. You know, this chart right here is near all-time lows. Okay, now typically things that are making all-time lows, they do tend to create new lows in the future, and you know, in the short future, as the trend is your friend and that trend could continue. But look at how steep and sharp this decline has been, right? In a very, very short period of time, this thing has just absolutely collapsed, where a lot of the moves take a little bit more time. Over here, we have UNG, XLE, new low timeline. So what I've highlighted on here is a little bit of a time frame for you guys over the past 10 years. So we had an 11-month period where we created a new low. And then after that new low, we ended up rising a little bit. Okay, then we have another 11-month period where we create a new low again, and then we start rising a little bit. Okay, over here, it took 10 months for us to see a new low, and then we start rising again. Okay, over here, we have a new low. It takes 7 months to make a new low from that point, from this low to that low, and then we start rising again. And then we make a new low after 5 months. We start rising again. Then we make a new low in 9 months. Then we start rising again, okay? And we have a low right here, and we've just made a new low, and this has been about 12 months of time already. So as you can see, you know, we're already over the normal amount of time within the past 10 years that it takes for UNG to start bouncing and really start performing better than the energy sector. So that's just some really interesting data, in my opinion. You know, we're at an unusually high amount of time that the natural gas performance has just been really, really brutal. Okay. Over here, we have UNG/SPX declines before the bounce. And again, this is going to be, you know, over the past 10 years. So here we can see that there was a 45% decline before we saw a bounce, okay? And then we had an 80% decline before we saw a bounce, a 57% decline before we saw a bounce, and then an 85% decline. We've currently been on a 75% decline. So what this means, and what I'm basically trying to extrapolate here, is that, you know, we're nearing that 85% decline amount, which has been the largest amount in the past 10 years. So, you know, this could have another 10% on this chart to drop. This thing could drop 99% for all we know. Okay, we can't really predict the future, but when you look at some of these things and you combine it with the previous chart about the timeline of a lot of these drops, you see that we're at an overextended, larger than average period of 12 months. Okay, and you know, we're very close to approaching this 85% decline number. So I just thought that that was pretty interesting. I wanted to share it with you guys. What we're going to do now is we're going to go ahead and hop on over to TradingView and go ahead and give you guys some nice TA. So starting off here first with the price of natural gas, the Henry Hub natural gas spot price chart. And we recently just tested our lows at 2.2 that I gave you guys in the last video. Okay, so this was our support level here at 2.2 right over here. And this low, all right, this support level is actually from over here back in August of 2020. Now, I do have another support level below right around 187. But when you take a look at the prices of natural gas, I mean, we're really approaching, some really historic lows over here, guys. I mean, we're talking about the lows of COVID. We're talking about the December, what is this, September 2020 lows right here are going to be right around 1.3. So, I mean, if this thing just wants to completely keep puking, we could come down to 187. We could come down to 1.3 before finding a bounce. Now, there's a bunch of arrows on this chart, all right? And, using, these support levels on the actual spot price of natural gas are going to help you understand some of the price movements between UNG as well as Boyle. But I want to highlight some different signals and potential signals that you guys can use to really, make yourself some option trades. Now, let me go ahead. I need to change one of these real quick. Sorry about that. But so what we have here is we've highlighted divergences, okay, and multiple divergences on the chart. If you're not familiar with those, right here, we're clearly in an uptrend, right? We're making a high and then a higher high right over here. Well, if you look at your RSI, the relative strength index, we actually have a divergence where we're making a high and a lower high. At the same point, we're making a high and a higher high. This is an indicator of some possible bearish activity in the future. And what do you see? We get a sharp decline afterwards. Okay. Now we also time that with a MACD sell signal, and that's going to be where this red line here crosses below the blue line. That's an exit signal. So a lot of times when you can get a divergence on the chart and RSI along with a MACD sell signal, those signals are pretty strong most of the time. And a lot of times you also find divergences on the MACD as well as the RSI. So for instance, over here, we're making a low and then a lower low. And here we have a low and a higher low right over here. So now we're building relative strength as price is dropping. The MACD is also in an uptrend. We get the MACD crossover right over here. So we get bullish divergence, MACD crossover, and we get a nice move to the upside off of that divergence. And this has happened many, many times, okay? Over here, making higher highs, we're making lower highs. We get a MACD sell signal, also a slight divergence on the MACD as it's going down while this is going up. Over here, we get lows, lower low, okay? We get low, higher low. And then what do we see? We get MACD crossover, move to the upside. And this has really repeated itself many, many times and has been some good signals and indicators into the market. Now, if you take a look, the MACD has been of no use right now, okay? What it's doing is it's chopping around, all right? And a lot of times when you see this thing chopping around, all right, that's going to indicate that, price isn't going to fall as quickly as it would with a normal MACD sell signal. And really it's going to chop around and, head in the same trend and whatever that trend is, whatever direction it is. So if you notice, the MACD started chopping around right over here and we've really just chopped lower and lower. So we need this MACD to start curling up, okay, and give us a nice buy signal, a nice entry signal. But we do have a bullish divergence, okay? So if you take a look, we have a low right here and a lower low here, obviously. We have a low and we have a higher low. So we're going to see if we can hold this trend line here and really break out to the upside. But something that's going to be holding us backwards is going to be this bearish divergence trend line, okay? So initially, we got a drop off of the price when we started making these higher highs right here and then started making lower highs on the RSI. So this is a bearish divergence trend line that we have. And if we come up, this trend line could push the price back down or at least the relative strength. So if you're bullish on this, you want to see us continue to hold this bullish divergence trend line, break out, retest, and head upwards, all right, against this bearish divergence trend line. Now, we'll go ahead and hop on over to the UNG chart right now and take a look at what we have going on over there. Now, UNG, obviously it's seeing some similar things according to, the actual spot prices of natural gas. If you take a look, we have a bullish divergence. Okay, so, we're making a low here. We're making a higher low. We're starting to bounce off of this trend line now. We just got out of oversold territory. The RSI is at 32 right now. 30 and below is the technical definition of oversold. And you can see that we're actually really respecting our 822 support level that we gave over here. Now, This, I believe, is all-time lows for UNG. Yeah, so we have our all-time lows here on UNG at 822. We just cracked them, okay? If we zoom in on the chart a little bit, we can see that we did crack these levels, and we actually started to find some support, okay? So we're finding a little bit of support here at our 822 level. We're seeing the MACD trend in the right direction, but it's a little bit choppy, right? It's going up and then back down, up. We do have some bullish divergence. We want to see these indicators really play out and give us some bullishness if you're trying to be bullish on this, right? You want to see this continue to trend upwards and really hold above this bullish divergence trend line. And you want to see the red line on your MACD really create some space from this blue line and show that we're starting to gain some momentum. All right. Now, we do have some price targets to the downside. So if we break our 822, we have 752 here is going to be the next support level. And the way we got that actually is through an ABC structure. Okay. Kind of using a little bit of some Elliott wave here. But if you take a look, we have our A wave down, we have a B wave up, and your C wave is going to be the 1.0 extension of your A to B, right? So what you do is you would come here and you would take your fib extension tool, all right? And you would take this from your high, connect it down here to your low, and bring it up here to your B, okay? And you can see it's right around that level that I just gave you guys at 752. I kind of just did this real quickly. It's not precise levels, okay? So this is the more accurate. So if this ABC extension or this ABC pattern really wants to play out fully, that could take UNG all the way down to 752. Now, if we take a look, the way that we can tell that this has been respecting and really following an ABC structure is your wave 1 and your wave 3. Okay, so your A wave and your C wave, those are going to be 5-wave structures. So if you take a look, we actually have a wave 1 down, 2 up, 3 down, 4 up, 5 down, and we complete that. Okay, let me make this black so it's a little bit clearer for you guys to see, right? So we have the 1 down, 2 up, 3 down, 4 up, 5 down, and then you get an ABC correction. Okay, so we'll go back here, and that's how you can tell that this is a corrective wave. Okay, so your wave 2 or your wave B is going to be a smaller ABC correction, right? And sure enough, that's what we ended up getting, right? So we got our 5-wave structure to the downside, then we got an ABC correction up, and we've started a 5-wave structure to the downside, but it hasn't been too clear if we're in a super extended wave 3, okay, of 5, or if we got a small bounce and we got our wave 4 already, right? So we have 1 down here, we have 2 up, then we could have 3 down right here, 4 up, and then our wave 5 would take us down here to the 752 target. All right. And so that's kind of what I'm thinking personally and tracking. But there is an even more bearish scenario that we just have to be aware of right now. I know I'm showing you guys bearish things. Okay. I showed you guys I do have a position in this, right? So I'm not a complete bear on this. I'm just going over some of the price targets and trying to figure out where we could potentially head. So that way, if I want to average down, I have price levels that I plan to average down at. All right. So if this is a 1, 2, and this is really just an extended wave 3, and we start to get some type of a bounce, okay, our wave 4 would be somewhere around here, and then wave 5 would take us down to our 1.272 extension around 287. So that is a possibility. It's definitely not the thing that I'm tracking, but I'm keeping an open mindset on it. All right. Now, there is a lot of data on this chart. I'm going to try and clear it up and get rid of some of this stuff. So that way you guys can understand some more price action and really how things are moving in the market. So it's no secret that we've been in a downtrend, and what I want to do is actually show you guys some of the major levels to pay attention to whenever you're in these trend continuations. Okay, so nothing really moves in a straight line up or a straight line down. What you do is you get retracements and then you get a continuation or a reversal, right? So you get a move up, retracement, continuation higher, or a move down, retracement, continuation lower. That's trend continuation. And the way you use and spot and track these trend continuations is going to be by your Fibonacci retracement levels, okay? Now, the 3 most common and well-respected are the 61.8, the 50%, and the 38.2. There are other levels, but especially if you're new to using the fibs, these are the 3 most common and well-respected ones that you want to pay attention to. And so what you're doing is you're connecting your swing high to your swing low, because obviously we're in a downtrend. And you see we come down, we retrace. Look at where we get rejected, the 61.8% retracement level. We continue that trend, right? We go down, we retrace up to our 50% retracement level, continue that trend. We retrace up to our 61.8% level, and then we continue that trend and head lower. So what we have to ask ourselves, okay, if we do start getting a bounce, and let's say, hey, let's say maybe we recently just put in the bottom, right? We just cracked our 822 support level, and let's say that that's our bottom, and we're going to get some type of a bounce because we have that bullish divergence, and then we also have the MACD kind of trending in our favor. Let's say these things really play out and we get a bounce. You need to be very cautious trying to go long or establish a new long position at these price levels, because we've been rejecting them and continuing the trend at these levels. Now, that doesn't mean we can't come down, come up, consolidate a little, and then break out past these levels. But I mean, it's just worth noting that you need to be extremely cautious trying to enter positions or exit positions at these levels. I recommend, setting some type of a stop loss at these levels. And once you get a breakout retest, you can always look for a re-entry with another stop loss on those levels. So that way, if UNG goes from 822 all the way up to 1647, let's say, possibly, you're pretty much at 100% gains right there. And if you don't sell or you don't have any type of risk management, and we end up rejecting that level as we've done in the past and heading back down lower, then you're going to give up a lot of those gains, or potentially all of those gains, because you weren't prepared. So that's definitely something that I'm doing, right? As you continue to make new lows, you have to draw these Fibonacci levels lower, because you're connecting the swing high down to the swing low. So if we head lower, then these price targets specifically will head lower. But for now, they're going to be 1323, 1485, and 1647. Let's go ahead and take a look at Boyle now. Finish up with Boyle. Okay, Boyle has a lot of the same structures. Okay, Boyle has been making all-time lows. Over here, we have some of the Fibonacci retracement levels, the targets. Now, here's a really good example of a Fibonacci reversal. Okay, so if you take a look, we had these swing high connected down to these swing low. We came down, we started consolidating, right? And then we broke through and actually got a reversal and made a high and then a higher high up here. So it is possible to break through these levels, but just, keep in mind that these are the levels you want to be cautious at, right? Because afterwards we had the downtrend, we came up, rejected at the 50%, and then we've continued that trend lower. Now, just like UNG, okay, we're going to drag these down a little bit to our most recent all-time lows. The main levels that I'm watching on Boyle, okay, is we crack through our 795 support level right here. 321 is going to be the big major next support level. Now, I know that's a lot of ways down compared to where we're at $6.10. That's nearly 50% drop. But, I'm using some really good, equations here to come up with these price levels. And Boyle is at all-time lows, guys. So, you're not going to be able to go back in the chart and try and find previous support. Okay, there's no previous support. So, I'm using the fibs to help give me some price levels. And as you can see, we did respect the 795 level a little bit, consolidate and flip it to resistance very well. And it's just continued to drop. But similar to UNG, if we do get a bounce, as UNG is also seeing the MACD start to curl up, okay, we're just not really getting that momentum behind the price action of the stock, okay? So if we do get a bounce, okay, 795 is going to be your big resistance level. Prior support is new resistance. So we need to crack above 795, and we need to crack above 1461. If we can do that, we have the chance of coming up to our major three Fibonacci retracement levels, which are going to be 1980, 2420, and 2860. These are areas that I would definitely be cautious at. Protect your trade. Don't force longing anything here just because you see it break out above. You could get a look above and fail and come back down into your range. So what you want to see is a breakout retest and then continuation higher. All right. So that's going to be it for today's video. Please smash the like button, subscribe to the channel if you guys are new, and I'm out.